Gold just hit $5,200 an ounce. Let me say that again. $5,200 for 1 ounce of gold. 6 months ago, that number seemed impossible. 12 months ago, it seemed completely insane. Today, it is reality. It is happening right now. And every serious precious metals investor on the planet is asking the exact same question. If gold just did this, what does silver do next? My name is Stack AG. Today, we follow the data, and we find out exactly what comes next for silver. Gold did not reach $5,200 by accident, and it did not happen because of speculation or hype. 3 fundamental forces drove it here simultaneously. And understanding these 3 forces is critical because these same 3 forces are now pointing directly at silver. Force number 1, central bank buying. For 3 consecutive years, central banks globally have been purchasing physical gold at record levels. Not gold ETFs, not gold futures contracts. Physical gold bars moved into sovereign vaults and held there permanently. China alone has been buying gold for 16 consecutive months without a single month of pause. 16 months. That is not a trade. That is a strategic policy decision at the highest levels of the Chinese government. And China is not alone. Turkey, India, Poland, Kazakhstan. Central banks across the developing world have been systematically moving their reserves out of dollar-denominated assets and into physical gold. When the largest financial institutions on earth buy something consistently for 3 straight years, price moves. That is not an opinion, that is arithmetic. Force number 2, dollar weakness. The Federal Reserve's rate cut cycle has been systematically reducing the appeal of dollar-denominated assets. A weaker dollar makes gold, which is priced globally in dollars, more attractive to every buyer outside the United States. European buyers, Chinese buyers, they are structural. Middle Eastern sovereign wealth funds, Indian retail investors, they all get more gold than their local currency when the dollar falls. That additional global demand compounds on top of already record central bank buying. And the result is a price that keeps moving higher, despite what mainstream financial media calls overvalued at every single level from $3,000 upward. Force number 3, geopolitical fear premium. War in multiple regions simultaneously. Escalating trade tensions between the world's 2 largest economies. Sanctions being used as financial weapons. Freezing sovereign reserves that were previously considered untouchable. Every one of these developments drives capital toward gold as the ultimate safe haven asset. Gold has been the refuge of last resort for human civilization for 5,000 years. That does not change because someone on financial television says it is overvalued. When the world feels genuinely uncertain, gold moves. And right now, the world feels very uncertain. 3 forces, all independent, all pointing in the same direction, all hitting simultaneously. $5,200 gold is simply the mathematical result. Now, to answer the central question of today's video, is silver next? There is one number that answers this question more accurately than any other indicator in precious metals markets, the gold-silver ratio. Right now, the gold-silver ratio sits at approximately 70-1. That means it currently takes 70 ounces of silver to purchase 1 ounce of gold. Let me show you what that number means in practical terms with gold at $5,200. At a 60-1 ratio, which is still above the long-term historical average, silver's mathematically implied fair value is $86 per ounce. We do not sell silver. At 50-1, do not sell anything. Represents the long-term historical average. Silver's fair value is $104 per ounce. At 40-1, which this ratio has reached multiple times in modern market history, including as recently as 2011 and 2020, silver's fair value is $130 per ounce. Silver is currently trading significantly below every single one of those numbers. That gap between where silver trades today and where historical ratios say it belongs, that gap is the entire thesis. And that gap does not stay open forever. Every major gold bull market in modern history has eventually seen silver close that gap. Not gradually, not slowly. Explosively. Silver moves faster than gold. Silver moves further than gold. And silver always moves after gold. Not before. Gold has already moved to $5,200. Silver has not moved yet. Now, here's the data point that most retail investors completely missed this week. And it may be the most important signal in this entire ratio update. BlackRock published every institutional signal, every macro shift, further significant gains for both gold and silver. Let me make sure you understand what BlackRock is. BlackRock is the world's largest asset management firm. They manage over $10 trillion in assets. 10 trillion. That is more money than the GDP of every country on Earth, except the United States and China. When BlackRock publishes bullish analysis on a commodity, institutional money moves. Pension funds read BlackRock Research. University endowments read BlackRock Research. Sovereign wealth funds read BlackRock Research. Insurance companies at family offices. Every major institutional allocator on the planet takes BlackRock's published views seriously. That institutional capital, flowing into silver based on BlackRock's published bullish view, sits on top of record industrial demand. On top of COMEX vault drainage. On top of central bank diversification away from the dollar. On top of safe haven demand from geopolitical uncertainty. BlackRock does not publish bullish precious metals analysis for entertainment. They publish it because their research team, with access to data that retail investors cannot even see, tells them that price is going higher. $10 trillion of institutional capital just got told to look at silver. That is not noise. That is a signal. Gold and silver surged today as traders priced in a prolonged conflict. That phrase, safe haven activated, is one of the most powerful forces in precious metals markets. And right now it is not partially activated. It is not warming up. It is fully engaged. When geopolitical risk rises, capital flows predictably. Out of stocks, out of bonds, out of currencies controlled by governments that can print them infinitely, and into gold, into silver, into assets that no government can create from nothing. Assets that have held value through every war, every economic collapse, every currency crisis in recorded human history. The current geopolitical situation is not resolving. Every headline this week confirms it is escalating. Trade tensions between the United States and China are intensifying. Energy markets are being disrupted by conflict. Sanctions are being deployed as financial weapons with increasing frequency. And every day that this uncertainty persists, the safe haven bid for precious metals gets stronger. Here's what makes silver's safe haven demand uniquely powerful compared to gold. Silver is simultaneously a monetary metal and an industrial metal. When safe haven demand activates, silver gets the same monetary premium that gold gets. Investors want hard assets with no counterparty risk. Silver qualifies completely. But unlike gold, silver also gets industrial demand from an entirely separate and independent source. Solar panel manufacturers still need silver regardless of geopolitics. EV battery producers still need silver regardless of what the Fed does. Semiconductor fabricators still need silver regardless of what happens between the US and China. Two completely independent demand drivers, both active at the same time, both pushing price in the same direction. Gold has one primary demand driver when markets get scared: safe haven flows. Silver has two, and that is why silver historically outperforms gold once its bull market begins. So what actually happens to silver from here, specifically? 3 scenarios, as always on this channel. Scenario 1, gold continues higher and ratio compression begins immediately. If gold pushes towards $6,000 and the gold-silver ratio compresses towards 60 to 1, silver moves to $100 or above within months. This is the bull case. It requires gold momentum to continue and institutional money to rotate into silver. BlackRock's published analysis suggests exactly this rotation is beginning. Scenario 2, gold consolidates and silver follows sideways. After a move from $3,000 to $5,200, gold, taking a pause to consolidate, is completely normal and healthy. If gold trades sideways between $4,800 and $5,400 for several weeks, silver likely consolidates in a similar pattern. This is not bearish. This is normal bull market behavior. Accumulation during consolidation is historically the smart money move. Scenario 3, macro shock, causes both to correct. If the Federal Reserve reverses course unexpectedly, if a major geopolitical de-escalation removes the fear premium, both gold and silver could see sharp corrections. A pullback to $4,500 in gold could see silver give back recent gains as well. Of these 3 scenarios, which does current data support most strongly? The consolidation scenario in the near term, followed by continuation higher in the medium term. The structural forces driving this gold bull market, central bank buying, dollar weakness, geopolitical fear, none of them are resolving quickly. And structural forces produce structural price trends. Nothing in this video is financial advice. This is data analysis and education only. Your investment decisions are entirely your own responsibility. Always consult a qualified financial professional. Now, practically, what does gold at $5,200 mean for different types of investors? If you already hold physical silver, this week's data strengthens your thesis significantly. Gold at $5,200 confirms the precious metals bull market is real and intact. BlackRock publicly bullish on silver confirms institutional capital is beginning to rotate. The ratio at 70 to 1 confirms silver remains historically cheap relative to gold. Hold your position, the data supports it. If you hold paper silver, ETFs, or futures, understand what you actually own. Paper silver gives you price exposure. It does not give you the asset itself. In an environment where COMEX vault drainage is accelerating and physical supply is becoming constrained, the difference between paper and physical matters more than it has in years. If you are on the sidelines, the relevant question is not whether silver is expensive compared to last year. Silver at current prices, with gold at $5,200 and a ratio of 70 to 1, is historically cheap. The question is where the data says it goes from here. Start small if you are new. Build a position gradually. Do not chase a single day's move. Dollar cost average over 3 to 6 months. Remove the emotional pressure of timing a perfect entry. And one final reminder that will never change on this channel. Anyone contacting you claiming to represent Stack AG in comments, in DMs, on WhatsApp, anywhere, offering to sell you silver or investment products is a scammer. Block them immediately and report them. Gold at $5,200 is not a ceiling, it is a confirmation. Confirmation that the precious metals bull market that began years ago is not over. It is accelerating. Central banks know it. BlackRock knows it. The data knows it. Silver, historically cheap relative to gold, with record industrial demand, with COMEX vaults draining, with institutional money beginning to rotate in, with safe haven demand fully activated. Silver has never had a more complete and multi-layered case for a major, sustained move higher. The only question that remains is the one only you can answer. Are you going to be positioned when silver makes its move? Or are you going to be watching from the sidelines, explaining to yourself why you waited? Stack AG is here every single day. So you always have the data before the mainstream does. Share this video with one person in your life who is still sleeping on silver. I am Stack AG.